Hello, this is Professor Broker with your Econ 231. Chapter 12, Lecture 2, dealing with the government, taxes, and spending. This is primarily going to deal with taxation. Let's get started. So, in a historical perspective, how has the federal government taxed the population? Well, when the nation first started, the federal government was relatively small and therefore had not as much need for tax revenue. And the primary taxes were excise taxes, really what we might term sales taxes on specific items such as whiskey. You might think about the Whiskey Rebellion early in George Washington's presidency, and this was a revolt over the whiskey tax. And then also there's excise taxes, on tobacco and other things and some imported items. And during the Civil War, it wasn't until the Civil War that you actually saw the first personal income tax, and obviously that was because of the country's massive need for tax revenue to fight the war. This was actually later declared unconstitutional. The way the wording of the Constitution originally is set up, the personal income tax actually wasn't constitutional. And so they had to pass the 16th Amendment to the Constitution, which made a personal income tax legal and constitutional. And therefore, in the early 20th century is when you actually got your first constitutional income tax. And the first income tax only applied to a very, very, very few Americans with pretty massive incomes, pretty large incomes. And that has obviously changed over time as well. Less than 1% of the population paid the income tax in the early 20th century. Okay? Today, most Americans pay some form of federal taxation. And this is where the United States falls in terms of our total government tax revenue as a percentage of our GDP as of 2011. This is where we fall compared to other countries. We are down here. We only collect about 25% tax revenue for our compared to our GDP, which is above some countries like Chile and Mexico and some other countries. But compared to most industrialized nations, you got your extreme sort of higher numbers in sort of northern Scandinavia, northern Europe, Scandinavia, as well as Western Europe like France. And most other industrialized nations collect more in tax revenue. Their citizens pay higher taxes than the United States does. And that's just important to realize, especially in relation to our government spending. One thing, and of course I'm not advocating a position here, but one thing to keep in mind is that the U.S. government and the U.S. economy, we really spend quite a bit of money, very similar to very similar levels to honestly some European countries and other industrialized nations. We spend about as much as they do, sometimes even more, but we actually tax ourselves substantially less. And so our middle class and particularly our lower income pay much lower tax rates than the typical European does, especially in Western and Northern Europe. And so, obviously, if you just look at the national debt equation, there's only two components. It's spending and taxation. And basically, if you want to just sort of a quick, sort of thought about why haven't politicians, fixed this problem, is because there's really not an easy politically feasible solution to this, because you either have to cut spending dramatically, and when we say cut spending, we looked in the last lecture that would have to include cuts probably to the military, which a lot of people don't like, cuts to Social Security, which almost nobody likes, or cuts to Medicare and Medicaid, which again most people don't like. And so those would be the three programs that would be most needed to be cut substantially to fix government spending. Most people aren't in favor of that. Well, the only other solution is to raise taxes, and of course, hardly anybody likes that idea either. And so that's one of the reasons we're sort of the fundamental reasons we're in the tough situation we're in. So where does the U.S. federal government get the money that they for tax revenue? Well, again, about 80%, you can see here, comes from between 75 and 80% comes from the personal income tax combined with FICA taxes. This is your Social Security and Medicare taxes. And so if you look on your paycheck, you're going to see, if you get a paycheck, you're going to see federal withholdings, and then you're going to see FICA withholdings. Okay, and so those two withholdings from your paycheck is the primary way, about 75 to 80% of the revenue that the federal government gets. We do get some money from the corporate system. Corporate taxation, as well as we still have some federal. For example, we have federal taxes on tobacco and gasoline. These are called excise taxes, and some import duties and other things. But again, primarily from paychecks. Okay, what about local and state governments? How do they get primarily their money? Well, about a third of state and local governments get money from sales taxes, right? Almost every state has a sales tax. Kentucky has a sales tax. Tennessee has a sales tax that's actually higher and applies to more things. Also, property taxes, right? Things like homes and cars and things like that, paying property taxes. This is really important for local governments. Some states do have individual income taxes. For example, Kentucky has a small individual income tax. Tennessee, Texas, other states do not have that, but some states do. And then some states do have a small corporate tax, and then there's some other taxes. But you can see there the primary way is sales taxes and property taxes. Is the primary state and local government's way to raise revenue, whereas the personal income tax is the primary way the federal government raises revenue. Now, how does our taxation compare to other industrialized countries? Okay. The United States, you can see here, relies actually more heavily on the individual income tax compared to other industrialized nations. Now, what that means is it's not that our individual income taxes are necessarily higher. That's not what these numbers mean. It simply means that we rely on them more. More of the revenue to the federal government actually comes from this source. That's what that means. And what this means here is essentially that the United States our tax revenue is more directly linked to the economic health of the nation. So as the economy tanks into a recession, because people are going to lose their jobs and we rely mostly on people having jobs to get our revenue, the tax revenue to the country is going to plummet substantially, even more so than in other industrialized nations. And so that's one caveat there in discussing that. Our social insurance taxes for things like Social Security and Medicare compared to other industrialized nations who also have similar pensions and so on are pretty similar. One dramatic difference within the United States, in terms of our taxation compared to other, especially European countries and also countries like Japan, is that we don't rely on consumption taxes. These are like sales taxes. In Europe, you might call it a value-added tax, a VAT, which is essentially a sales tax applied to goods and services. And so we don't have a national value-added tax in the United States like in many European countries. And so this makes our tax burden a little bit lower, and it's important to remember that these value-added taxes. So a lot of people would like to see very similar systems in terms of public pensions and public health care and so on and so forth, like some of these Scandinavian countries. It's also important to remember that these countries have usually substantially larger, not only personal income taxes, which tend to be progressive. But they also have much larger value-added taxes, which we could term sales taxes, which don't tend to be progressive. And middle-income and low-income citizens of those countries are going to be paying a higher percentage of their income towards purchases of goods and services with those sales taxes. And so that's, the United States doesn't have that. It's one thing that makes our system, progressive. But other countries do have that. And then we do rely more on property taxes. That's especially true at the local and state level. And then corporate taxes are roughly the same. We have a little bit higher corporate tax rates in the United States compared to other countries. And so that's the big. Those are some of the big similarities and differences. Okay. Now, what is the difference? We need some terminology here. What are some differences between what we might call an average tax rate versus a marginal tax rate? Okay. The average tax rate is simply going to be the total amount of taxes that an individual pays divided by that person's income. Okay. And it's a good measure of the sacrifice the typical taxpayer is making. Okay. Whereas the marginal tax rate is really the tax bracket that you're in. And if you earned an extra dollar of income, the marginal tax rate would tell you how much that extra dollar would be taxed at. Okay, not what your total tax rate is, but simply what your marginal, your next tax rate would be on the next dollar earned. Okay, and it measures sort of the incentive effects of taxes. Okay, maybe you get offered to do an extra job, where you'd earn a little extra money, but maybe your marginal tax rate is 50%. And so, in other words, by doing that extra job to earn an extra $1,000, you would actually only get to keep about 500 of it. Well, that could, obviously alter your incentives and say, well, it's not worth it for me to do that extra job because it's not worth only $500 to me, which is the only amount I would get to keep because of my marginal tax rate. So here is a tax table from 2010 under U.S. federal law, and this is roughly similar. It's basically the same. It's a little bit different today in 2015, 2016. Today, there would be an extra bracket down here with about a 40% tax rate for incomes over roughly $400,000, and these numbers have been increased for inflation a little bit, but this is roughly the same tax table. And what you see is that for everybody, the first $8,000 and change of income we earn is taxed at, say, 10%. Okay, that's true for everybody, and then only income above $8,000 and change and up to $34,000, that chunk of money is taxed at 15%. And then if you're blessed to earn more above $34,000, between $34,000 and $82,000 and change, that's taxed at 25%. And then this chunk of money between $82,000 and change and $171,000 is taxed at 28%, and so on. And that's how the tax system is set up. So that's what I mean by average versus marginal. To find average, you would simply add up the total amount of tax you pay divided by your income, whereas marginal might be, you might be in this, you might be earning $150,000, and your average tax rate might be something like 15 or 20%, but your marginal tax rate is actually 28%. If you earn an extra dollar, $150,001, then that extra dollar would be taxed at actually 28%. Okay? So again, what would be your marginal tax rate if your income was $50,000? Well, if you would find the bucket that you're in, $50,000 falls not in that bucket, but actually in this bucket. So if you earned an extra dollar, currently earning $50,000, that extra dollar would be taxed at a marginal rate of 25%. Okay? Now, what about your average tax rate if you earned $150,000? Well, to calculate that, you would take, what you would actually do is you would work through a problem where you would take this $8,375, you would multiply it by 10%, giving you $837.50 as your tax bill for that bucket. You would find the tax bill for this bucket, which would be $34,000 minus $8,375, which is the amount that's already been taxed. Okay, you would take that, multiply it by 15%. You would subtract these two numbers, right? $82,400 minus $34,000 that's already been taxed. Multiply that by 25%. Then you would take $150,000 in this bucket, subtract the $82,400 you've already taxed, multiply that by 28%, add up your total tax bill. That total tax bill then should be about $35,709.25. That's the total amount of tax you would pay, doing it in the manner that I just prescribed. You would divide that by the $150,000 of income, and you would get an average tax rate of about 23.8%. So usually your average tax rate is going to be less than your marginal tax rate. Well, and in fact, this person's marginal tax rate would actually be 28%, right? So your average tax rate is typically going to be lower than your, in this progressive system, than your marginal tax rate. Now, there's three types of tax systems we can think about. We can think about a proportional tax system. This is a tax system instituted where taxpayers pay the same fraction of income regardless of income. If so you might think about a 10% tax, right? And so, 10% of 10,000 would, be $1,000. 10% of 100,000 would be $10,000. But they would both be paying 10%, the same proportion. And we don't have an exact proportional tax in the United States. Something that's close to a proportional tax would really be our FICA taxes. Those are close to being proportional. Everyone, really up to a certain level of income, but pays the same percentage, right? 6.2%. Employers pay 6.2% towards their Social Security payment, and then there's also a percentage for Medicare. And it's the same percentage regardless of income, and so that would be pretty close to a proportional tax in the United States. How about regressive taxes? This is where high-income taxpayers actually pay a smaller fraction of their income compared to low-income taxpayers. And you might say, well, no country would ever do that. Actually, most countries do have regressive taxes. If looked at by themselves, they tend to be regressive. A good example of a regressive tax is pretty much any excise tax, any sales tax is going to tend to be regressive. So think about a tax on gasoline or even food, right? Who pays a larger percentage of their income on food? Someone who only makes $10,000 or someone who makes $1 million? Well, pretty obviously, right? I mean, the person with $1 million might actually spend more money on food, but as a percentage of their income, it's actually going to be smaller. Whereas someone who only earns $10,000 might spend $8,000 or even $9,000 of their money, or something like that, on food, or maybe something less, but still a very high percentage. Therefore, if we tax food, then the poor person is actually going to be paying a larger fraction of that compared to their income than the rich person. That makes it regressive. So sales taxes, value-added taxes in Europe, these taxes tend to be regressive. Then there's progressive taxes. These are taxes where high-income taxpayers pay a larger fraction of their income compared to low-income taxpayers. So this is basically like an income tax, and most income taxes tend to be progressive, where the smaller your income, you pay not only less in taxes, but you actually pay a smaller percentage. And then someone who's wealthier or who has a larger income will tend to not only pay a larger tax amount, but they will pay a larger tax rate or a higher tax rate as well. So progressive taxes. Okay, so proportional, regressive, and the United States income tax system does tend to be progressive, and we'll look at some of that data in a little bit. Okay, so let's look at this table here. And so here we have incomes we have 3 individuals, and we're going to look at them being taxed 3 different ways and sort of the definition of 3 different tax systems. So there's someone who earns $50,000, someone who earns $100,000, and someone who earns $200,000. Under this first tax system, right, the $50,000 person pays 15% in taxes. The $100,000 person pays 25%. I'm sorry. $25,000 of a tax rate, of a tax bill, and then the person who earns $200,000 pays $40,000 in taxes. And obviously, doing the math there, you can pretty quickly discern that this is a regressive tax system. 15,000 divided by 50,000 is actually a 30% tax rate. Okay, in other words, this lower income person is actually paying a higher rate than the person who makes $100,000 and $200,000 because they're only paying 25%, 25,000 divided by 100,000, and the rich person is only paying a 20% tax rate, 40,000 divided by 200,000. So tax rates are going down as income is going up. That's a regressive system. Okay. Now, what about the second tax system? This person, $50,000 of income, is paying $12,500 in taxes. Right? That would be 25%. 25,000 again divided by 100,000 is 25%. 50 divided by 200 is also 25%. Each person, regardless of their income, is paying the same percentage of tax. That's a proportional tax. And this last one, 10,000 divided by 50 is only 20%. 25 divided by 100 is 25%. 60 divided by 200 is 30%. That is a progressive tax. As incomes are going up, tax rates are going up as well. And so that would be a progressive tax. Okay. Here are some average federal tax rates by income quintile. And I've sort of already talked about this, right? And so this is basically this group right here is the poorest 20% of income earners in the United States as of 2007. This represents the next 20% of income earners. This represents the middle income, kind of the middle class, middle 20%. This is the the next 20%, and then this is the top 20% of income earners in the country in 2007. Okay, the richest 20%, the next richest, the next richest. Okay, the next richest, the poorest 20%. Okay, and then this is everybody, but we won't worry about that right now. What I want to point out is the blue bar is our individual income tax. How much these different groups are paying in individual income taxes as a rate of their income. Okay, the green is corporate income tax. Okay, and the reason that even poor people have some corporate income tax is because of tax incidence, and some of that cost is passed on to workers in the form of lower wages. So that's captured here by the. This is done by the Congressional Budget Office. Then you have excise taxes, which are like sales taxes. Okay, and then you have social insurance taxes, which is the purple bar, which is FICA taxes. Okay, and I want to point out what basically I said earlier. We have some regressive, proportional, and progressive taxes in this country. So notice let's first talk about proportional. Look at this purple bar. It's pretty much the same until you get to this very top income group. It's pretty much the same for all income groups. They pay the same percentage, okay, and that's to be expected. I mean, it's a flat rate. The reason it drops off up here is because actually Social Security is capped, and so it's actually capped to a certain income level. Primarily, I think, because the Social Security Administration doesn't want to pay out excessively large benefits on someone who earns an excessively large salary during their working life, and so they cap the tax because they also want to cap the benefits. But you can see here that it's primarily proportional. You can see the excise taxes is actually a larger percentage for poor people, and it goes down as incomes go up. That's a regressive tax. So excise taxes on tobacco, on gasoline are regressive. The poor pay a higher percentage. They have a higher bar here than the rich do. Then you can see our corporate tax, it tends to be progressive, but that's not a big part of tax revenue. A big chunk of tax revenue comes from the individual income tax, and that is very progressive. If looked at just by itself, the individual income tax is very progressive in the United States, regardless of maybe what you've seen people say on television or whatever. If you just look at the numbers, the poorest 20% of income earners in the United States, at least in 2007, these numbers haven't changed dramatically. In fact, they're more progressive. They actually paid a negative income tax rate. What does that mean? That means that these income earners actually got more back from the government, probably through tax credits, like the Earned Income Tax Credit and others. They got more money back from the government than they actually paid in taxes, in income taxes. So there's a negative income tax rate for the poorest 20%, also a small negative for the next 20%, and then the percentage paid in income taxes goes up pretty dramatically here as people get richer. And so our individual income tax system does tend to be very progressive. Now, some other considerations you might want to think about are taxes and efficiency. One tax system is more efficient than another if it raises the same amount of revenue at a smaller cost to taxpayers. What are some examples of costs to taxpayers? Well, obviously the tax payment itself. But then also, remember, we talked about in Chapter 8 the creation of deadweight loss from taxes, right? And so, one thing, that governments probably want to think about is we want to have fairly efficient taxes as well as equitable taxes, but we also want efficiency. We want to be able to raise a good amount of revenue without destroying a lot of economic activity. That would be measured by deadweight loss. Okay. Also, administrative burdens. Some taxes are much more burdensome to implement than others. And so, you might ask yourself, why do European countries tend to have a value-added tax? Well, just to be honest, it tends to be a relatively easy way to raise quite a bit of revenue. It's very difficult to avoid a value-added tax. And so in terms of, tax evasion and so on, and pretty much all taxpayers are going to have to pay it at some point. And it doesn't cost a lot to administer a value-added tax in terms of an administrative burden. And so, that's definitely one reason why a lot of industrialized countries have it. And of course, I'm not advocating for one. I'm just saying, obviously, they have one, and that might be one of the reasons. Almost everyone agrees that the U.S. tax system is very inefficient. There's lots of loopholes in our tax system, especially our income tax system. There's lots of tax preferences given. There's a pretty large administrative burden in terms of the IRS and so on, where we are paying lots and lots of money to raise lots and lots of money. And there are some movements to try to make our tax system more efficient. Then there's taxes and equity, okay? And so obviously efficiency is not the only concern with a tax system. Obviously, another thing is, we want to, maybe as a public system, we want to raise revenue from those most able to pay and maybe transfer some to those who are maybe less fortunate. And so that would be sort of an equity concern. So we're going to just talk about some principles dealing with equity. One problem with talking about equity is it's very, very difficult to determine or to agree upon what is fair. It's pretty easy to agree upon what's efficient. One tax system is more efficient than another if it raises the same revenue but at a smaller cost. Well, those are concepts that are easy to define and easy to agree on. What constitutes a fair tax system? Some people would say if everyone pays 10%, that would be a fair tax system because everyone's paying the same rate. But other people would strongly disagree with that, and they say they would, there would be lots of different opinions, and so it's very, very difficult to agree on what's fair. But let's talk about some principles. For example, horizontal equity. This is the idea that taxpayers with similar abilities to pay should pay the same amount in taxes. Again, the problem is it's difficult to agree upon what factors besides income determine ability to pay. Let's look at one example. We have two families that earn $80,000 annually. One family has no children, but Mr. Smith has an illness causing $30,000 in medical bills in the given year. Okay, we've got another family who didn't have any medical bills, but they have 4 children, and 2 of them are in college generating $40,000 in tuition payments. Would it be fair to have these 2 families pay the same tax because they have the same income? Okay. Again, we're probably going to get lots of different opinions on that. Some people would say, well, going to college is a choice, and so maybe they shouldn't get to deduct some of that tuition. Others would say, well, but going to college, sending their kids to college is helping out the economy. The medical bills, you can't really necessarily, predict medical bills or prevent them. And then someone might say, well, what if, it was caused by maybe some lifestyle choice that primarily caused the medical bills and so on. And we would get into lots of debates and about should they get some tax deductions or breaks because of these costs, either medical bills or tuition, even though they have the same income. Very, very controversial. Okay? Another principle would be the benefits principle. This is the idea that people should pay taxes based on the benefits they receive from the government services. So the federal and state gasoline taxes, almost all of that money goes directly into road funds to fund the paving and the building of highway infrastructure across the nation. And you might say, well, how is that the benefits principle? Well, who pays, who's going to pay the gasoline tax? Well, people who buy gasoline, obviously, are the people who are going to pay the gasoline tax primarily. And the more you put gasoline in your car, the more you're doing what? The more you're driving using the roads, which is what the revenue is used for. So there, you see the benefits principle there at work in the gasoline tax. Okay? Then there's another concern or principle, and that is the ability to pay principle, also called vertical equity. The idea that taxes should be levied on a person according to how well that person can shoulder the burden. In other words, the richer you are, the higher the ability to pay you have, and therefore you should pay a higher tax rate. Okay? There should be equal sacrifice. And so maybe a 10% tax rate on someone who makes $1 million a year isn't the same sacrifice as someone who only makes a 10% tax rate on someone who makes only $10,000 a year. Okay? Again, equal sacrifice, it's probably going to be tough to agree upon a definition of what sacrifice means. But again, obviously this is something that as a populace, as a country, we have tended to care about. Okay, this can also be thought of as vertical equity. So this, if you're concerned about the ability to pay principle, again, you're going to advocate for progressive taxation within the system, right? And so a good question to ask is the U.S. federal tax system progressive? Because you've different movements like Occupy Wall Street. You've seen there's other think tanks out there that and they really sometimes claim that not only should our tax system be more progressive, but actually they would claim sometimes that our tax system is not progressive. So what does the data say? Okay, well, here's some data from the Nonpartisan Congressional Budget Office as of 2013. These numbers are actually would be even more progressive today. But what do you see? Over the last several decades, this is the top 1% of income earners and the average federal tax rate that they've paid. Okay, I mean, this is the actual tax rate that they've paid. Okay, you can see that it's way up here, usually in the high 20s or low 30s or sometimes even mid 30s. As of current law, it's about close to 30%. This is the next 9%, the 81st to 99th percentile. This is the next 9% richest in the country. Okay, so this is the top 1%. This is the next richest 9%. They pay, currently something in the low 20s, average 20, low 20% in terms of their federal tax rate. Then you can see here basically what we might term the middle class. Okay, the middle 21st to 80th percentile. This is like the middle 60% of income earners in the United States. Paying average federal tax rates of something around between 10 and 15%. And then you can see the poorest 20% in the United States, and that even currently their average federal tax rate, including all federal taxation, is barely positive. You're talking 1, 2, even 3% in terms of all federal taxation, including excise taxes and FICA taxes and so on. Okay, and so just based on our definition, higher a progressive system is as incomes go up. Okay, and so as incomes go up, just like these bars, line graphs, then the average federal tax rate should also go up. Well, that's what we see here in this picture. That's what we've seen over the last several decades. And so, and in fact, you can even make the argument that over the last 5 to 10 years, our system has become even more progressive. As you see here, the top 1% paying a little bit more, and the bottom 80%, you can see these tax rates plummeting for those income earners. Okay, and then here's a neat graphic that not only factors in taxation. Now this is for 2011, but this also factors in subsidies paid out to income earners. And so this captures, so like this is sort of the average market income. This is the poorest 20% of income earners, the next 20, then the middle 20% of income earners, the next 20, and then the highest quintile is the richest 20% of income earners in the United States as of 2011. You can see the average income here in this group was about $234,000 and change. The poorest income group had an average income of about $15,000. Okay, and you can see here government transfers, and then their average tax bill, the average tax rate paid, which this corresponds pretty nicely to what we saw in the previous graphic. But then they factor in what is their total federal taxes minus government transfers for this income group. In other words, if this was negative, like it is here for this income group, what that means is on average, this group got more government benefits or transfer payments than they paid in federal taxes. And you can see that for what I think is striking is that the poorest 60%, for each of these quintiles, the bottom 60% of income earners in the United States actually received more back from the government than they paid in taxes, and only the richest 40% paid anything positive in taxation after factoring in transfer payments. And in fact, it was the richest 20% that paid in. They had by far the largest positive number compared to these other groups. And so, and again, you can look at these tax rates here. And so, if you factor in government transfer payments, then not only is our system progressive, it's actually much more progressive once you factor in these transfer payments to these families. And so again, I'm not arguing, and no one in this class is arguing that we shouldn't raise taxes or we should raise taxes or anything like that. It's not a normative position, but simply a positive, factual assertion that we do currently have in our United States federal tax system a fairly progressive system as our starting point.